Welcome, everyone, to this wonderful webinar we have planned. We're going to just wait a second or two here before we kick things off, and I hand it over to our lovely moderator. All right, hopefully everyone that has joined, but thank you again for tuning in today. My name is Lily Taft Richard, and I'm a member of the CFA Society of San Francisco. I'm also the chair of our Young Leaders Council. It is my absolute pleasure to welcome you to today's webinar, Technical Analysis Beyond the Voodoo. I think this is going to be really exciting since many of our members have more of a fundamental background. And our speakers today are a wealth of knowledge on this subject. We've got Jeffrey Hirsch, Fred Meissner, and Katie Stockton. So just a quick item before we start, you will be muted for the event. So we encourage you to type all questions in the Q&A box. We will monitor it. Don't use the chat box there. And then last but not least, we will try to answer all your questions, but we may not get to everyone. The event will also be recorded, so you can share the replay with people if you'd like. But without further ado, Roman, I will let you take it away. Roman is a senior equity trader at Main Street Research Wealth Management. So thank you, Roman.
Thank you, Lily. Well, thank you all for being here. I'm super excited for the event we have planned today. Thank you again to all of our presenters. Just to give you a little debrief on each of them, Katie is the founder and managing partner of Fairlead Strategies, an independent research firm and investment advisor focused on technical analysis. Previously, she spent more than 20 years on Wall Street providing technical research and advice to institutional investors. She also has served as the chief technical strategist for BTIG and chief market technician at MKM Partners, and was the vice president for the Chartered Market Technician Association from 2012 to 2016. So thank you for being here, Katie.
Of course, Roman. Glad to be with you guys today.
Our next presenter is Jeffrey Hirsch. Jeff is a CEO of Hirsch Holdings, editor-in-chief of the Stock Traders Almanac, which is actually something I always keep on my desk, and the publisher of Almanac Investor at stocktradersalmanac.com. He's authored 2 books on the impact of market cycles and seasonality, and is a frequent contributor to CNBC, Bloomberg, Fox Business, and other financial media outlets. Thank you, Jeff, for being here.
Appreciate you guys having me. Great to be with you.
And our last presenter will be Fred Meissner. Fred is the founder and president of the Fred Report, a consulting service for financial advisors, and he also speaks extensively on markets and market analysis around the world. His professional career spans 41 years in the investment business, including senior market analysis positions at the Robinson Humphrey Company, Merrill Lynch and Company, and 4 years as the president of the Market Technicians Association, which is the predecessor to the current CMT Association. Thank you all for being here. We're so excited to start. Well, I'm just going to tackle it head on. You all are here with the Beyond the Voodoo, but I want to start with our presenters kind of explaining some common misconceptions about your work in technical analysis. Katie, I kind of want to start with your kind of framework in terms of how you conceptualize it and how it complements a fundamental strategy.
So thank you, Roman. I appreciate it. And I'm glad to be with everyone today. It's funny, the Beyond the Voodoo title, I protested against this, but I also understand where it comes from. It's funny, way back when, this was probably 10 years ago, Mike Santoli wrote an article, I think it was for Barron's, or maybe even 15 years at this point, but a long time ago, he wrote an article, and it was counting the number of times that technical analysis and voodoo were found in the same article. So this is where it comes from. And that is one of those common misperceptions, right? But my process is very much a process, right? We are subjective in how we're looking at things, and yet it's very, very mathematically based, right? So not an emotional process at all. It's very sort of orderly and systematic in how we're approaching markets, and we're looking only at price. So the price trends are the most important to us. We actually don't even use volume in our process. And we're taking those price trends, which thankfully are really easy to access and identify these days. And then we're laying over a bunch of indicators. So these technical indicators are where the math comes in. And it's in how we combine all of these indicators that we arrive at our takeaway. And our takeaway, I guess, is partly for the trend input to help manage risk, to understand where there might be opportunity. So we use it in a fashion that really is pretty unemotional, and that's our approach. If I were to address, I guess the skepticism or sort of, different approaches between technical analysis and fundamental analysis, I would say that, yes, they are quite different, but they're very complementary. And I think that's the most important takeaway from today. So not that I want people to hang up here, but I think that taken together, they are just more powerful, because if you can think about technical analysis as something that will enhance or otherwise perhaps what you're already doing from a fundamental perspective, that's the service that it provides. And you don't have to be overly complicated in how you approach it. My process probably will look pretty complicated to some folks, and yet the outcome and the takeaway is really quite simple typically. So it doesn't need to be very difficult in terms of integrating technical analysis in some level, just to add to your probabilities, right? I think that's at the end of the day what we're all trying to do, is to keep trends on our side, have probabilities in our favor, and have systematic or disciplined ways to manage risk. So that's how I see it.
And then Jeffrey, considering your background is more on seasonality, I think that's a very powerful tool in terms of shifting the probabilities in your favor. What are some common things you find yourself tackling with someone who, maybe hasn't heard of seasonality or doesn't understand the impact that it can make on their investment decisions?
Well, I think if technical analysis is deemed voodoo, I think seasonality is like black magic or something. I hear a lot of people, just not believing that it exists, that, people behave in repetitive or repeating, patterns. We all do the same things, different times of the year, day, month. We pay our bills, we go on vacations. Just to echo what Katie said, I don't use this in a vacuum either. Fundamentals, technicals, seasonals, amongst other macro and monetary policy trends and sentiment are what we look at. So, my domain is cycle, seasonalities, patterns and trends, the 4-year cycle, market seasonality. But it's interesting how these days I'm hearing people talk about it more and more on the financial news. Everyone's talking about October volatility, and here it is happening. And I think one of the main misconceptions that I find is that when seasonality doesn't transpire, people want to throw the flag at it and say, oh, therefore it doesn't work. But what I've discovered over the years, and discussed it with many, in the business, especially my CMT friends, is that when seasonality doesn't work, it becomes an indicator. There's an old quote from Edson Gould that if the market doesn't rally during the bullish season, then there are other forces that are more powerful. And when that period ends, those forces really have their say. I've flipped that recently to comment on the lack of a sell and May period, or what we call the worst 6 months, and we didn't get any major sell-off in August or September. I think intraday we had about 3.18% from Wednesday the 8th of October to Friday, the low there intraday, and that was sort of rounding up and down. So that's a bullish indication to me. When the bearish season didn't happen, you've got, more bullish forces at play. You've seen new all-time highs in September and October. And this is just where we begin. I have a 5-discipline approach. Seasonality happens to be our foundation. We start there. We look at fundamentals. I do a fundamental stock screen. We look at, you know, GDP and jobs. I know right now it's hard to see the jobs numbers, but initial claims are what we like to look at. And technicals, market internals, and then monetary policy, and of course sentiment. I happen to like the investors' intelligence, bullish and bearish advisors for my sentiment readings. But yeah, I mean, seasonality works. I think the 59th annual edition of the Stock Traders Almanac is a testament to the fact that it does work. You've got one. I know my friend Katie has one. I don't know if Fred has one, but it's still working. It changes, but we track that.
Thanks so much. Yeah, no, I think, you know, when you go into your doctor's office, if he just took your vitals and then let you be on your way, if your vitals looked good, you'd think something was up. You needed someone to check on the vitals, which is kind of how I think of the fundamentals. In addition to asking you, so, you know, what do you do on an average week? How often are you staying active? Things like that, to get kind of a more holistic approach to putting the probabilities in your side. Fred, last, what are some things that you've kind of encountered along your career in terms of, you know, I know one of your flagship things was when the CMT Association was actually able to put that designation on par with the CFA in terms of getting allowing that to be exempted from Series 86 in terms of Sarbanes-Oxley. So I'm sure you've encountered more than your fair share of people that felt like they're on the other side of the aisle as you.
Sure. Well, I'd like to mention two things. First of all, most of you people on the call are from California, and one of the things I always loved about the Series 86 was the common California expression, he's been 86th, which means to be drunk and disorderly and thrown out of a bar. So I think of fundamental analysis not necessarily like that, but it is interesting that they managed to choose that series number. Probably the most important experience I had in that area of skepticism was working with the Market Technicians Association Educational Foundation, getting technical analysis into universities as a course. And one of the people I was working with on this looked at me. This was at the University of Texas at Austin, so not a small school. Looked at me and basically said, well, we don't like technical analysis because it doesn't always work, as Jeff Hirsch said. Now, what I thought was interesting about that, I looked at the guy, I said, oh, so fundamental analysis works all the time, right? And there wasn't a lot of, you know, there was sort of people looking at each other and saying, well, geez, that may not be a really valid objective or objection. What I like about technical analysis, and of course I look at fundamentals, I've worked as a strategist and such, is that technical analysis is a great way to measure your fundamental expectations, or in the case of, say, cyclic, you know, expectations. If you're looking for a cycle low and indicators move down into the position traditionally associated with a low, that gives you added confidence, which Katie put, I think, very well. It increases your probability of success. And again, what we're all really looking for here is success. So my sort of overall methodology is quite simple, at least what I teach to the financial advisors who are my clients. I have a way to measure trend that's very simple. I have a way to measure overbought and oversold conditions that works well in trading ranges. And, of course, I work with sentiment and stuff, and I agree. Also, I like the investors' intelligence sentiment numbers much more than any of the other ones, and the main reason for that is they are the only numbers that have been derived from polling the same group of people, the same type of person since the survey was started in 1962. So I'll stop there and let you go on if you have any questions. Obviously, I look forward to answering them there.
Well, thank you, Fred. You know, consistency and data integrity is absolutely paramount when you're looking at something like, you know, trying to derive a mathematical approach to the markets. So I guess that's a good segue into my next question. What frameworks or individual technical indicators do each of you really value highly in terms of, you know, if someone were to take away all of the tools you have in your tool belt and they'll give you one back, which one would you find yourself gravitating towards in terms of providing the best, you know, one-off benefit, or gives you the most summary of how the market is as a whole?
Well, Roman, I'll chime in. I mean, the indicators are so important to my process, but I can't imagine just being beholden to one of them, because if you back test an individual indicator, chances are good you won't get the results you're looking for. It's really in how you combine the tools that we have at our disposal, I think, that you can have success, because they're trying to tell you different things about the characteristics of that security. And I say security because technical analysis lends itself to anything that has a price, not just stocks, of course. So when we evaluate momentum, we have a couple tools to that end. When we evaluate overbought, oversold characteristics, we have a couple tools to that end. And then relative performance. Those are sort of the three categories that are important to us in our process. And with different environments, we're probably weighting the indicators that we use the most differently. Sometimes we're even ignoring some of them. And it's just really to respect the characteristics of the market at that time. I'll give you one example. For the momentum indicators, we use the traditional MACD indicator. And we also use moving averages of price in the cloud model, which is maybe a little bit more obscure to everyone, but it's just a visual gauge of trend. So the MACD has been incredibly noisy on the daily S&P 500 chart since the, I'd say not the April low, but since I'd say the end of May or mid-May, it's been just a real mess. Not helpful in its signals, in my opinion. And so once we tuned into this characteristic of the market, which of course has seen 3-day pullbacks on average or so, we just stopped looking at it. And I stopped also looking at our stochastic oscillator, which is our overbought, oversold input on a daily basis. And we started to focus on the 20-day moving average as a smooth gauge of trend, because we saw the noise, we saw the characteristic had changed, and we just adapted to it and kept at least one of our trend following metrics on our side, and we prioritize that. And then we also prioritize the market internals, which already both Jeff and Fred have alluded to, which are, sentiment, leadership, breadth, things of that nature that will give you a sense of the health of the market or the health of a move. So we looked at the VIX for one, which is in our world, a transactional gauge of market sentiment. So we said, we're going to watch the 20-day, we're going to watch the VIX. Those are our primary risk inputs. And just in the past couple of weeks, we finally saw a shift in both. So it's really interesting, that the market is dynamic in the way that it is. And so there's no one recipe, I think, that works all the time in all markets, but it's how you can take all of your experience, collectively and look at these charts and see patterns that you'd seen before, or setups, cup and handle formations, things that are a reflection of where there's support and resistance, things of that nature. That's where the art of technical analysis is so important, just the experience of looking at these charts.
Absolutely.
I didn't really answer your question.
No, it makes sense.
So it would be hard, yeah.
Right now. But you said MACD, Katie, and that was my number one pick. And the way I learned it from Jerry Appel, the inventor's original work, was that you use MACD to confirm an entry or exit based upon other analysis. And for me, as we all now know, is seasonality. So if I had to pick one, it would be MACD. We use more than one different kind of MACD. I know, Katie, you've done a lot of work with different ones, but I use that to confirm seasonal entries and exits. And again, forced to pick one, that would be it. But the other ones that the master technician has mentioned are definitely worth looking at. The important part is technical analysis is an art, and it shifts, and you have to move with it. It's just like, if you're a offensive coordinator or defensive coordinator on a football team, you make adjustments at the half. You have to make adjustments with respect to the market, and I think Katie's taught us a very important lesson there. I would throw out a fundamental one as well, because I know, the group that we're speaking to here is about that. And I was my original, teaching in stock analysis was price to sales is the number one thing we look at. We look at, and we use it relative to the market or to a sector that we're looking at. So when we look for stocks, when we do our stock screens, price to sales is our top, cutoff. It's got to have something that's reasonable, at least relatively. So MACD and price to sales would be the technical and fundamental ones I would pick if I had to choose just one each.
I love that. Thank you, Jeffrey. And Fred, what are your thoughts?
Well, I would be similar but different. I would use a combination of moving averages, and I teach the 5-day or 5-period moving average and the 20-period moving average. The MACD or MACD indicator is actually what that stands for is moving average convergence divergence, and I like to see them converge and diverge directly rather than using that indicator. I noticed when reading Jerry Appel's work that that indicator has a downward bias mathematically, so I've sort of tried to get around that by using the actual moving averages themselves. I want to ask a real basic question, though, that I think is important in terms of a way not only to measure sentiment, but to sort of frame what we're doing here, and that is, what is a chart? A chart, to me, is a graphic depiction of people's buying and selling decisions and supply and demand. And when I look at people buying and selling stocks, and I've been around a lot of people that buy and sell stocks, one of the things I've noticed is that when you look at their decision-making process along with the idea of Maslow's hierarchy, you're right at the bottom of Maslow's hierarchy. You are buying stocks to make money. You are selling stocks because you're afraid they're going to go down. No one I know has ever bought IBM to achieve self-actualization. So you can actually see what people think if you look at a chart in that way. And for me, moving averages would be it, simply because they're the best way for me to measure trends, although, of course, they have limitations.
That makes sense. Yeah, I think it all can boil down to a few things, and I think that's, Katie, you've alluded to it, but I think it's helpful just in the sense of there's so many indicators, there's so much financial news out there. How do you simplify all of that into kind of a framework that allows you to take everything that's coming at us from now social media, in addition to more original TV and wherever you get your news from? It seems like we're getting constantly barraged with things that could potentially have an impact on price action and whatnot. So how do you kind of think about that or sift through that to find the signal versus just the noise?
Yeah, I mean, it's a matter of smoothing it out. So just like Fred mentioned, the moving averages are incredibly important. They inherently have a lag, and that sometimes, upsets people, but that lag is by design. It helps us eliminate the noise, right? Just in the same way that I use the 20-day on the way up. I feel that when you see these moving averages, whether it's a crossover that you're waiting for or simply a change in slope, they can be very good ways to understand if the change in trend is meaningful over whatever time horizon you're concerning yourself with. So that could be very different for different people. Someone long-term may not even want to look at a daily bar chart, but just rather keep maybe the 12-month moving average or a longer-term one on their side. So that's the simplest way, I'd say, to sort of manage through noise, smooth it out, and try to understand if you have a meaningful trend shift underway. The other way we do that also, listen, we're always waiting for confirmation. And by that, I mean, breakouts and breakdowns are among the most informational events, I think, on the charts. And that means when you see a stock clear previous resistance area, then it tends to keep going. It tends to generate additional price momentum. And there's concepts that make sense to everyone, I think, in the room probably behind that. But these breakouts, you got to make sure that they stick. And again, it's related to your time horizon. But let's say we're trying to identify, actually, we talked today about Apple. Apple reached a new high. That new high was above resistance around $260. So what we're requiring for that breakout to be confirmed is 2 weekly closes above, consecutive weekly closes above, to make sure that it's real, as opposed to a whipsaw higher. Because whipsaws and shakeouts, meaning like sort of shaking out the weak holders when you see a false breakdown, those are really common. And they're really common when volatility picks up, especially, and when emotions are running high. And we've seen a little bit of both this month, as Jeff mentioned. So we want to make sure doubly now, because of the volatility, that Apple's breakout is confirmed before we act on it. And honestly, waiting that amount of time is usually a good thing anyway, because then you don't find yourself, chasing a shorter term overbought move, but rather let the market consolidate a little bit and digest those gains and give you perhaps a better entry. There are certain setups that tend to see that immediate follow through, so it'll be maybe a little bit less stringent, like a triangle formation. We're less stringent if we do see those. But the waiting for confirmation is another way to make sure it's meaningful, especially around events like earnings. You look at earnings reactions. Oracle gapped up, but it came back within that gap within days. That's usually a bad thing. AMD gapped up, stayed above that gap for the next week. That's usually a bullish development. So we have these kind of qualifiers that we use.
Interesting. Well, thanks so much. And just because the calendar is always there, Jeff, it's always reminding us, where we're at, and excited for Halloween coming up. But how is that,
one of the best turn of the month trades out there in October and November.
Yeah. And how does looking at the calendar and seeing typical seasonality help you distill all the noise anyways, or allow you to insulate yourself from it? Or do you incorporate any sort of, news events into your perspective on timing trades and whatnot?
The seasonal backdrop, knowing the market's biases and, even intraday biases helps. But simply, I shut it off. I mean, I'm human, I'm emotional. Sometimes people might think I'm more emotional than other people just as a personality, but I've learned over the years to check my emotions at the door. And I think that's simply you go back to doing your analysis, your research, look at your somebody asked me, I was doing a talk to some kids, some college students. They asked, so how do you check your emotions? I said, you do the work, you do your homework while the market's closed, or while you're not trading, or while you're not looking at the market, and you come in with an exit strategy and an entrance strategy, and you just turn it off. I mean, put the phone down, look at your system, whether it's seasonal, whether it's Katie or Fred's array of technical indicators, and you look at those, what they're telling you and what the readings are in an unbiased, unemotional moment, and you just shut it off. Seasonality helps, though.
Well, I think it's just another, tool in the toolkit, right? To understand where people's money may be going. Fred, do you have any thoughts on that? And if not,
Yes, I do, and I'll be maybe a little bit controversial here. It is probably apparent to the people watching this webinar that I have dialed in on a landline. The way I avoid the news and all those sort of noise is I'm probably am the only person in my demographic in Atlanta that does not own a television and hasn't since 1969. I'm not on social media. I try to ignore all of it. And honestly, Roman, what I found with my indicators and ways of doing things is, and I can prove this to anyone who would love to see it, I don't think there's any difference in the markets at all from the 80s to now in terms of the way the indicators work. They seem to work exactly the same way for me. So there's no change at all.
Well, that's certainly contrarian. But you know, when you have a certain amount of time in the market, I'm sure you can understand which situations your indicators work versus in which instances they can be faulty, right?
Yeah, and I hear stuff. Obviously, you hear, President Trump was elected, right? It's kind of hard to miss some news, but at the same time, it's not really what the news is, it's how the market reacts to it. And that's why I tend to focus a lot more on the charts. And, I'll see CNBC if I'm out at a restaurant or something like that. And, it's interesting to see, but I really do try to avoid most of it. And I think what Mr. Hirsch said was completely appropriate, which is you turn it off. The difference with me is, honestly, I kind of never turn it on unless it's by accident.
Fair enough. Well, I will say,
yeah.
Being from my demographic, I think not being on social media would be a tough sell for most people around me. But I do what I can in my own way to insulate as well.
We use it because we do a lot of dog fostering. That's really all we look at.
Well, there you go. Well, we got a question from one of the participants, and I think it ties directly into this in terms of news-driven market moves. How did your technical indicators, and we can either take this one by one or do a free-for-all, how did your technical indicators help you or not help you during the April sell-off, specifically in the days after Liberation Day, but also throughout the remainder of the quarter?
Yeah, that was really, oh, sorry, go ahead, Fred.
No, I was going to say, Katie, you go first, and then I'll go last if that's appropriate, but we should probably keep in the same order. I think it's more organized. So, Katie, please go.
Thanks, Fred. So what, first of all, I love hearing that from you because it is so unique to sort of limit yourself to all that noise, Fred. And I think it's probably been beneficial in your long-term investing, I would guess, not to pry, but
yes, and also just in my life in general. I don't worry about a lot of stuff.
Yeah. I wish my teenagers could turn it off. Anyway, so just in regards to the April low, what was beautiful about it, and I'm quite sure the room will agree, was that we had such massive extremes in the market internal measures. So the way we track those, and they're not, the primary input is trend, momentum, overbought, oversold, relative performance, but the market internals, I always call them kind of tertiary to that, and support and resistance levels. But we pay attention when they're at extremes. So in April, we had pretty massive extremes, not just from one, but from a collection of them. And again, these are the measures of breadth and sentiment leadership. And we kind of present them in aggregate in our morning note, where we show things that are related to up and down volume, advancers, decliners, the CNN Fear and Greed Index we like as a sentiment metric, volume on the exchanges, so overall volume, not individual stock volume. So when we have this collection of oversold extremes, we really pay attention because it is a bull market cycle typically. So you rarely ever get these extremes. And so we were able to capture the April low pretty well, but I'd say by the time mid-August or mid-May came, we were very skeptical of it at that point. So we were, I'd say, on the sidelines until the breakout in June. Oh, you're on mute, Jeff.
Thank you. Sorry. We got stopped out of some stuff on the way down. It was, right. Unfortunately, it was right near the beginning or the end of the best 6 months. So there were some issues there. But, VIX at 50 is a buy. And I think we all learned that again. And then about a week later, once we started clearing those levels, we got back into our Russell and NASDAQ positions, which was quite beneficial. So you got to remember this. You got to learn from these moments that when fear is so rampant like that. I mean, Katie listed a whole host of other metrics, but I think VIX was pretty clear that we were at a low. I mean, VIX over 50 is a buy. So technicals work there.
Very good. I'll go, and I can tell you exactly the thought process we had leading up to the low. we were looking at the sentiment going into the Liberation Day tariffs, and we had been, because some of the indicators like stochastics and such were oversold, we were kind of expecting a low in March. And there was one problem with our thoughts on a low, and it's very educational, very interesting, and that is I keep an indicator of puts and calls. And in terms of sentiment indicators, let me just mention that Investors' Intelligence Sentiment, which we've referenced here, is what I call a condition indicator and not a tactical indicator. And the thing I always use as a tactical indicator coming off a low is the put-call ratio. And that was also indicating extreme complacency. So when the market came down in April, we finally got the spike we were looking for in the put-call indicator. That was key number one. The second one was we had a very big outside day positive reversal on April 9th. And that means, again, excessive demand, not supply, when the market was going down. So that was one of our keys as well. And then when we exceeded the high of that day on April 25th, that was our confirmation that the market was going to rally, and so we were sort of playing that. Now, where I did screw up was we didn't sell a lot, or at least people would say I could have screwed up. We didn't sell a lot going into April because we had been expecting a low in March, and the low basically came 2 weeks after we were expecting it. So we were not sellers in that time period. We were actually buyers in that time period. We didn't, and still don't really see anything in the charts to suggest that you would have had that. And then, of course, Roman, that you've seen in my work, that 5 and 20 period moving average that I worked with also gave a buy signal in there right around the time of when we exceeded the high of that particular bar. And so that was basically our thought process in there. What we did work very well, if you were able to ignore the fact that tariffs were going to destroy the economy completely and, business was going to stop. I will also mention one other thing. If you look at the history of tariffs have never destroyed any economy. And if you look at, again, the Smoot-Hawley tariff, there was a lot of other factors around that. So that didn't destroy the economy then either. So that would be my answer to that question. Probably convoluted, and if you want clarity, please ask, or if anyone in the presentation, the spectators want to ask, I can certainly go into that.
No, I think all that makes a lot of sense. And I think it's important in moments like that to stay disciplined, and given technical analysis gives a lot of tools to look at that. One of the tools that isn't even necessarily explicit technical analysis is limit orders or things along those lines. Does anyone on the panel use any sort of strategies like that in order to stay disciplined when, emotions may be running high, or are you mostly relying on, your ability to remain disciplined?
I only use limit orders religiously. Good to cancel, and outside real-time hours if I'm looking to make a position. Stop losses, however, I do not put an official stop loss out there because it will get hit by the market makers. I use our rule in the newsletter is if the stock or security closes below our stop loss, then we go in the next day and we trade it or get out of it. So stop losses are on alert, limit orders are in there.
What about you, Katie?
Yeah, so we manage an ETF as well. We have the Fairlead Tactical Sector ETF, or TACK. So TAC is very much rules based, right? So we're not putting in limit orders by any stretch, but rather reacting to the signals that we're deriving from our model month over month. So we're doing a monthly rebalance, and each month we reevaluate our technical indicators and the rule that is based around them, and we'll make our decision and effectively place the trades the next day. We are not employing a stop loss discipline, but when we do recommend individual stocks, which we do in a couple of different forums, one of which is our Substack newsletter. It's called the Fair Lead Idea Generator. And in that, we actually put in a stop loss always, like a threshold, and a price target. And that target's derived from either resistance or something like a Fibonacci extension or measured move. For the stop losses, we always, just like Jeff, we will say, for us, it's not just one close below. We'll usually say 2 closes below. So there's our confirmation requirement. And if it's a short-term level, we use 2 daily closes. Longer term, it might be 2 weekly closes. So we'll have qualifiers. So in that, with that in mind, we're not usually out there with orders in our sort of personal investing habits, but rather always taking sort of a reactive wait and see approach. Let's see if this is confirmed, and let's see if we can advance towards this objective, and constantly reevaluating. Has a new sell signal popped up? This is one area in which we think technical analysis, for even the biggest skeptic, has a great sort of added value, is in a sell discipline. And we have indicators like our DeMark indicators that we use. It's a third-party service from Tom DeMark. And those will generate signals that are automated and based on, again, math and price. Those signals, if one pops up, we might say, you know what, we're close enough to our objective or close enough to resistance. There's a little downtick in momentum. That's enough for us to say that the probabilities have lowered to the extent that we want to reduce that position. So we're more fluid, I would say, in how we're approaching trades, and more systematic, and almost to the point we're doing like quantitative technical analysis, scoring systems, things of that nature, when we're talking about creating a portfolio.
Absolutely.
Very good. I'm going to mention just a couple of things. I will use limit orders most of the time, especially on ETFs, which is a lot of what I do. But at the same time, I will use market orders during a panic, especially to buy. I do use stop orders, but differently than a lot of people do. It took me about 20 years in my career before I realized that you don't have to use a stop loss on your whole position. You can use it to simply cut the risk of a position. That took me a long, long time to figure out, because I started in the business trading commodities, and in commodities with the leverage, you want a stop loss to take you out of everything. But with equities, that's different. So you can use stop losses to sell even on the way up on retracements if you've got a position that's weighted a little bit too heavily in your overall portfolio. So I'll use that sort of strategy in that regard.
Interesting. Yeah, I think that's contrary to the way in which most people use their stop orders, but it makes sense.
Yeah, once I realized that, golly, I just don't have to stop and lose my whole position, it was tremendously liberating. I could cut my risk and still have a position.
Well, and like Katie said, I think that is one of the main benefits that having these kind of hard, clear-cut, technical, mathematical indicators can provide, is the ability to manage your risk in the moment, even when layering over a fundamental approach. And I know for me, when I first was getting into technical analysis, it was all Edwards and McGee. It was all pattern analysis. And now that I'm, gearing up to take my 3rd level of the CMT exam, I understand it's so much deeper than that. But for someone who may be new to the world of technical analysis, do any of you use pattern analysis, or is it more just conceptual, technical indicator based?
Yeah, I mean, listen, if I see a price pattern, I'm excited about it. I see them, they have silly names, honestly, some of them, but I see them as manifestations of supply and demand. So, and also of where there's, support and resistance on a chart. So a head and shoulders, right? All that is a higher high followed by a lower high and then a breach of support, right? And then there's the inverse version of that. So it's trying to assign a visual sort of picture to what the chart is doing. And of course, what the chart is doing is a reflection of supply and demand. So that lower high is there because people were selling at a lower level. They were eager to get out, even partly with a retracement. So it shows market psychology manifesting itself in price trends. So we're definitely focused on indicators on our end, but we also prioritize support and resistance levels. In fact, that's really the visual exercise that we're doing oftentimes when we're looking at the charts, because we're looking for breakouts and breakdowns and things of that nature to help us discover opportunities and manage risk. And with those breakouts and breakdowns, there's often the completion of some kind of price pattern. Triangles are my favorite. A good triangle example of late would have been Tesla. You'll see that there was like a converging series of higher highs and higher lows that we were able to take advantage of. You can see longer term triangle formations. There's one that we just highlighted this week in India. So INDA, it's an ETF. Looks like it's advancing from a triangle formation. Oh, and yields, by the way, 10-year yields just broke down from a long-term triangle formation. So when we see these patterns, we definitely get excited because some of them we feel are pretty, I guess, high probability in their outcome.
Yeah, patterns. I mean, seasonality is all about patterns. So recognizing stuff on the chart, in addition to some of the support and resistance stuff Katie was mentioning, I look at gaps and consolidations for levels that we want to get in or out of for stops or buy limits, and previous highs become resistant. So chart patterns for sure. Sometimes you really get into that art aspect of technical analysis where you're looking for some sort of recognition visually on the chart for where a security looks attractive or where you want to put some protection. But I mean, just like we had back after the April tariff tumble, when we started breaking through those resistance levels, that was a pattern that was hard to ignore to get back into this market and continue to just let your winners ride. Once we cleared a few of those important levels, so definitely patterns.
We have some oh, sorry. Go ahead, Fred.
I was going to mention I use patterns, and I do want to mention, especially for the people watching this, Katie is right about some of these names. I use candlestick charting. I'm a friend of Steve Nissan, who actually brought candlestick charting over here from Japan. And it must be disconcerting for our viewers to see in candlestick charting my two favorite patterns, which are the abandoned baby formation and also three crows on a fence. So tend to forget the names and look at what the patterns actually represent.
We're smiling, Fred, if you can't see us.
I can't see you, but yeah.
The W123 swing bottoms and the M123 swing tops are good ones that we look at also.
Yeah.
Well, we're getting some awesome engagement in the question and answer, so I think we'll just transition over to that. I'm going to pick out one of the panelists that I think would be custom built for each of these questions. Well, first of all, Jeff, a question for you. One of the participants said he loves seasonality for the big picture of the market. He uses it on an asset class level for stocks as a whole or a sector in particular, but now he sees people using seasonality on individual stocks. What's your perspective on the merits of that?
I don't really subscribe to the individual stock seasonality. I use seasonality for the market, and then we pick stocks in there when the seasonality becomes favorable. I mean, I think some people can have some success with it, especially the big stocks that are driving the market, that are really the market. But if you're looking at smaller stocks that aren't Mag 7, or we used to look at IBM as sort of like a benchmark for the market way back, if you get into individual stocks, unless it's something that's real seasonally oriented, like a commodity type thing where we use correlated, say metals or food stocks to go with some of the commodity seasonalities, I don't see the effectiveness of using individual stock seasonality, just in general. I mean, there's a few spots that it works, but not overall.
Thanks so much. I'm going to direct this next one to Fred. One of the participants asked what we could recommend as a source of info for definitions of indicators and the appropriate uses or pros and cons. I know your experience, you should have a good one for that.
Very, very simple. There's a wonderful book called Technical Analysis of the Financial Markets by John Murphy, who's a hell of a nice guy. It also has a study guide, and that is probably the best overall book for definitions of technical indicators and the teaching of the basics of technical analysis.
Perfect. Thank you. And then there's one other question. Katie, I think you can take this one. It's more about the concept that technical analysis is self-fulfilling prophecy. Just that the reason technical analysis works is speculated to be because other people believe technical analysis works. Do you have any thoughts about that?
I mean, you could imagine I disagree with it. There are elements of technical analysis that are probably self-fulfilling. Sometimes, as an example, you'll see something hold right at a key level, and you know that that level is very widely followed, like a 200-day moving average, and it pivots right there. I don't think that's always accidental. So I think there is some elements, or are some elements of self-fulfilling sort of indicators and tools. Even our DeMark indicators that we're using, when you watch them intraday, sometimes I suspect that there's honestly a lot of traders watching them. I remember when one of the signals would flash when I worked at Morgan Stanley, the trading desk would just go wild. So you knew that they then were imparting the signal to a lot of individual firms. So you can see how that might happen. But overall, technical analysis is really trying to understand, again, that supply and demand dynamic. And it will never work. So I know that there is that perception that technical analysis works until it doesn't, but that doesn't really make any sense. It's more, just a reflection of the current environment, and it tells you what is happening. It's not trying to be predictive, but it's giving you more information about how buyers and sellers are behaving. And for it to be totally, I'd say, manipulated by a group of technicians or doubters would be extremely, I'd say, like just impossible because of the number of market participants. And as much as we might think there's a lot of communication, whether it's through CNBC, we have people like Fred who aren't even watching, right? So there's a whole big world out there of folks that are looking at very different things. So I think to get to that collective doubt that would have any impact on global markets would be pretty an extreme environment. But definitely there are instances in which that may happen. And instead of that being a bad thing, I see that as a bit of a gift from the market. And I would caution anyone who's investing to not know where the 200-day moving average is or any other kind of widely followed input.
Thanks so much. Well, given that we only have about, oh, sorry, go ahead, Fred.
Let me throw one thing in there because I do think that there's a problem with that whole idea too. If it worked because everyone else was using it, well, then everyone would be right all the time, wouldn't they? Right?
Yep.
And they're not. So it's fairly clear that technical analysis is not a self-fulfilling prophecy to me.
Well, and I think all of your longevity in the financial field, I think, is a testament to that as well. So we got 6 minutes left. We'll close it up with the question that I think everyone is curious about: is a quick little hitter on your outlook for year end and 2026 as a whole. I've heard you a couple of times, Jeff, so I've got to hear yours first. You're muted, Jeff. Sorry, one more time.
Sorry about that again. I'm calling for a monster Q4 rally. I think this, as I mentioned before, the bullish behavior in bearish season, all the new all-time highs in September and October. And we're on pace for one of the best, worst 6 months since 1950, up about 20%. At least it was at the end of September, pretty much right around there. October volatility, very typical, setting up. There's a lot of wall of worry, bearish sort of, anecdotal sentiment out there. I don't see it, so I'm calling for 7,100 by year end. That's the upper end of my best case scenario that I put out in December of 24 in my newsletter, and even earlier than that in the middle of 24 when we put out the almanac. So, but one of the things I learned from my father years ago is that year ends make great exits. And we are looking at a midterm election year, which has been, the weak spot of the 4-year cycle, the Q2, Q3 period of midterm year 26. And already in my 26 almanac, which I put to bed around Memorial Day, is I'm expecting some volatility, market weakness, crisis, bear market action, perhaps a mild bear market, economic weakness. I think some of the tariff issues and some of the other fiscal concerns that we have going on here will come home to roost in the middle of the year, kind of like we had in 22. Remember, 10 of the last 16 bear markets have bottomed in the midterm year. October 22 is a textbook October midterm year bear market. So after we hit a little negative territory in the middle of the year, I think that sets up what I call the sweet spot of the 4-year cycle. Q4 of the midterm year through Q2 of the pre-election year for about 4 to 8% gains by year end. As it stands now, I reserve the right to update that as we get to the end of this year when I do my forecast and beyond. So that's it.
Fred, what is your take on the action to the end of the year and start of next year?
I think it's probably going to be fairly strong going into the end of the year. I've been looking for an advance that's going to start actually in the next week or so, and I agree with Jeff. I don't think we're going to see some of these overbought readings in some of the leadership stocks last. So I would expect to see some weakness in the leadership names. Maybe some of the value names do a little bit better, and that could last through, say, July or August, again, because of the midterms. We should have clarity then. But I don't really have any trend-based sell signals coming in, now. So you ride the horse as long as it's eating, grass or whatever they eat.
Thank you.
How's that for a sports metaphor?
Hope the horse can keep going.
Yeah.
And Katie?
We don't really make a practice of assigning year-end objectives. So Jeff, you say you reserve the right to change your mind. I always say the same because the market is truly dynamic, and if it changes, honestly, we'll change with it. I think I recently heard Paul Tudor Jones say the same, and I really appreciate that because we can't control it. But we can certainly make sort of, I'd say, educated inferences about the current action. And right now, what our indicators suggest is that we're in store for 7-8 weeks of consolidation. That's based on a combination of the MACDs, the 20 days, our DeMark indicators across different time frames, and also our sector work and bottom-up work and market internals. So it's really all of the inputs that we take in. Those are collectively supporting consolidation. We always assume that the prevailing long-term trend will maintain itself. So we are long-term bullish within that context of looking for corrective price action, which is new for us. We just sort of assigned this newly skeptical short-term bias in the last week. So we feel that the longer-term setup is still very favorable. There is a signal as of last month from the monthly DeMark indicators that is worth watching. And we don't react right away to these. We wait for them to be confirmed. So it's that confirmation that's more important to us. But we did also see them, 2 of them, right before the end of last year. So knowing what we know about this year and aligned with following price patterns and setups, it is something that nags at us a little bit and simply will make us more inclined to manage risk should we see either confirmation of the signals, some kind of breakdown, or deterioration beyond what we're seeing right now.
Thank you so much. I think that's a perfect tone on which to close this out. Well, thank you so much to all of our participants. Again, thank you to our panelists for taking your time to share your insights with all of us. And we will, for any people who are curious about the work that these 3 fantastic participants are doing, feel free. We just posted some of the their links in the chat that will give you some specifics about how they're doing what they do and how they, marry fundamentals and technicals and go about exercising their expertise. So thank you to all, and have
Thank
a
you,
fantastic
Roman.
rest of your day, and have a great rest of your year.
Thanks,
Thank you.
Roman.
Thanks,
for having us.
everyone.
Thanks for joining us, everybody.
Appreciate the time.